Good morning. This is Barry Knapp with Ironsides Macroeconomics. This is the free version of the weekly audio summary of our full research note. The note this week was titled Higher and Steeper. It's an obvious reference to the Treasury curve. We have been talking all year about two potential outcomes, or most likely outcomes, for the economy and the markets. One was our quadrilemma thesis, the idea that in order to get the Fed to cut the policy rate to 4% in 2024 or shortly thereafter, the level that would disinvert the curve painlessly and open the bank credit channel, allowing banks to finance small businesses, real estate, loans that need to be rolled, like multifamily projects that were started within the last couple of years at much lower policy rates and much higher rental growth, and the federal government for that matter. We would need the unemployment rate to rise above 4, wage growth to fall below 4, and that was in essence our quadrilemma thesis. Friday's number makes that a much lower probability outcome than another yield curve bear steepening like we had from August through October, largely due to the fact that Treasury is going to shrink the amount of bills outstanding and issue more coupons, some $519 billion over the next couple of quarters. And in order to do that, they need the banking system to participate. Banking system really can't participate if they don't have visibility to getting a normally shaped yield curve such that those securities will actually carry positive. So that was the big takeaway from Friday's payroll report. Within the note, we dug into a couple of spots where it is still very much consistent with our view that credit is tight for small businesses. The NFIB small business hiring plans index fell again this month. It's been in a steady downtrend now for greater than 6 months. Small business job gains in the ADP report were very tepid. The birth death model didn't really, which is not a great near-term indicator, did not point to small business hiring gains. We're getting more part-time jobs than full-time jobs. But those are the only soft spots in the report. Everything else implied that this thesis that increased immigration is leading to a big increase in the supply side of the labor market is looking increasingly evident. We had a pickup in the household survey. We had much stronger labor income. The work week ticked up. Wage growth returned to its 0.3% trend, but they also revised the previous month up. So we're running a little bit hotter than that. Within wage growth, we're seeing really strong gains in construction, an area that should have responded negatively to all the Fed tightening, but did not because of very, very loose fiscal spending. When you discuss financial conditions, you have to be very clear that if you are an entity that finances yourself on the front end of the curve, like a small bank, like a real estate developer, like small businesses, or the federal government, conditions are indeed tight. But if you are an entity that is benefiting from the highest, most accommodative fiscal spending since World War II, as measured by government spending relative to the size of the economy, conditions are loose. And that's also true if you can finance further out in the curve, because Fed policy has caused this deeply inverted yield curve and negative premiums for long-term premium for longer-term lenders. So moving on, this week's going to be all about the inflation numbers, Wednesday's CPI, Thursday's PPI, and the one that doesn't get as much attention but is crucial to the outlook for goods prices, which was the primary source of disinflation in the second half of the year, import prices. And that'll come on Friday. We'll obviously be writing all about that this week. It should be a little better than the last couple of months, but recall this idea that seasonal adjustment factors put downward pressure or upward pressure, on inflation. We think the case was actually stronger with the labor market and the employment numbers, and they didn't revert in March. So we may be somewhat disappointed on Wednesday, Thursday, and Friday with the inflation numbers. We then went into a big earnings preview and a very complex part of our note. In order to see all that, we suggest you become a full paid subscriber. Barry Knapp, Ironsides Macro. Have a good week, everyone. And we suspect probably your best bet here is to buy some puts on regional banks, small caps, and TLT if you primarily trade equities. But we do think the yield curve is going to go higher and steeper, and that will eventually be a problem for equity investors through 4.5 on 10s and through 2.25 on 10-year tips, real rates. We think the equity market will start to get concerned about that. Barry Knapp, Ironsides Macro. Have a good week. Thank you.